Hello and welcome to another episode of the Student Loan Punter Podcast. I'm your host, Travis, and today we're going to talk tax FAQs. Now, this for me is kind of like getting a tooth pulled because nobody likes taxes. I think my favorite part about taxes is filing them and being done. So that said, the other favorite part about tax season is not having to pay a bunch of money on my taxes that I didn't have to. So what I thought we would do is I asked the social team to go source some questions that you've got from social media. And so we'll read off a couple of those, talk about a couple of the answers, and then I'm going to feature a special guest at more the end of today's show. So quick disclaimer, of course, this is not personal tax advice. You got to talk to your specific professional for your situation. So let's just jump right in. So first question comes from Instagram. Someone says, explain the pros and cons of filing separately if we have no kids. So, these are dinks, dual income, no kids. And think about what this means, right? You have two people both making an income, maybe one of them is making an income. What does it all mean? So if we've got, let's say the folks are in a normal state like New York or something, right? If one person has debt and the other doesn't, the filing separate strategy is way more important because you're talking about excluding the other person's income from your IDR payment, which can make a huge difference. So just pretend you've got, two people each making $100,000 a year. One person has debt, one doesn't. You file separate, your payment is going to be based on $100K of income. If you file joint, it's based on the $200K combined income. Now, if you are both student loan borrowers, then if you file separately, you're not double counting things, right? When you file joint, you're basically having a proportional payment that's split up based on the size of your debt if you file joint. So this particular couple that has no kids, they actually still might benefit from filing separate, even if they both have debt. And the reason is the way the deduction works for the poverty line for the SAVE plan. So remember, the SAVE plan is 225% of the poverty line is the deduction. So for a family size of one, that deduction is about $33,000, meaning that you can make up to $33,000 and pay nothing. Everything above $33,000 is taxed at 10% is the SAVE plan IDR payment rate, right, for grad loans. Now, if you're a family size of two, that deduction is about $44,000 instead of $33,000. So you might think, okay, well, if we both have debt, file joint because we get a $44,000 deduction instead of $33,000, but not so fast. If you both have student loans and you're filing separately, you're one of these dink couples, dual income, no kids, then your deduction is each $33,000 because it's a family size of one. And so that's $33,000 times two protected income instead of the family size for two. So that's a total deduction of $66,000 before you have to pay 10% of that income versus the $44,000 deduction if you file joint. So that's an extra $22,000 of protected income. 10% of that is about $2,200. So what that means is if you file taxes separately, are you going to save, enough to cover the costs of filing separate? So let's say, let's say you lose like the student loan interest deduction, which is about $500 in costs. That cost is about $500. That's what you lose if you file separately. But if you're gaining $2,200 on your student loans from filing separately, the net cost is $2,200 minus $500. It's $1,700. Now you might add on the costs of hiring a professional to have to do your taxes instead of being able to do them on your own, which, you can do your taxes on your own. The real reason to think about whether or not you should is, will you cost yourself more money doing them yourselves than by hiring somebody? And the other thing is, do you enjoy doing it and spending your time doing it? So there's all things to consider. So that's the first question. I'm probably a little bit too long time spent on that, but we'll keep it moving. How do you know if you should file jointly or separately? Just to recap what I said earlier, it basically just depends on, is the student loan benefit of lowering your payments much, much better than the extra costs you incur by filing separate? So remember, when you file separate, the IRS usually takes more of your money as a joint unit. The reason being is if you have a big difference in your incomes, it puts one spouse into a higher tax bracket. That's the easiest way to think about it. There's also some deductions and some credits that get cut in half or eliminated completely. So things like the capital loss deduction of $3,000 is cut in half. Contributions dependent care FSA is cut in half. There's a lot of things like this, right? If you have a small business, there's different impacts to your QBI deduction if you take that. So there's a lot of things you want to think about in terms of filing jointly or separately. And, that's one of the reasons we have tax people now, because we just felt like this was so important. So next question from Instagram, verifying if I'm doing the same plan, do I need to file separately from my husband? So again, it depends, right? If you have, $10,000 a year hit to your taxes, if you file separate, you probably shouldn't file separate. There's other situations too, of course, for people living in community property states. That's, California, Texas, Louisiana, New Mexico, Arizona, etc. There's about 9 of them total. Wisconsin, Washington State, those are a couple other ones. I think Nevada, and maybe a couple other ones that I'm missing. I think I said Texas and Louisiana. So another question, how do I find a CPA that's experienced in multi-state income households? A lot of times there's people that are familiar with locum tenens work, if that's what's driving this. The reality is you can pretty easily find a CPA that's experienced in this, but the problem is their price might be not affordable. This is really the big battle, in my view, for most of financial services, is you can almost always find somebody who's really experienced in any given problem that you have. But the problem is are they also affordable? Because I know some CPAs that I've worked with in the past that do have the ability to handle multi-state income, and they charge like a huge amount of money. So we are tackling this ourselves with people that have multi-state situations, but in some cases we have to charge a little bit extra because it just takes time to do the research on things. Next question, who's the best person to do my taxes in general? So it depends. It depends on what your main pain point is. If you are, a business owner with a very, specific specialty and a practice owner, if your main pain point that would cost you the most money is that, you probably should have somebody that really specializes in doing, practices or, tax returns for orthodontic practices. I hope that we'll get there at some point. We do have a decent amount of expertise on our team, but I think that you want to identify what is my main pain point, and then what's the best value that I can get for getting that pain point handled by a professional. So, in general, if you're going to go pay $300 to a tax prep person, you absolutely cannot expect they're going to have any specialized knowledge in the field of student loans or in the field of tax planning, right? If you're paying like $300 to have somebody do your taxes, it is literally them punching in numbers and filing your return, and there's no tax planning. If there is, you found a unicorn, right? It's just, if you've got any kind of like few $100 cost of tax prep, that's a commodity business where you're looking at the commodity being you having a filed return. Well, that is a definable thing. You can literally have that return get filed, and then, it's done, it's turned in, whatever the taxes due or refund you get, you get, and you move on. What you're not seeing there, though, is the planning and the strategy behind things and the advice that you need to be able to know what to do, right? So, anybody can put in tax software, right? There's not a lot of value in that, which is why, if you're looking for tax prep, there's such aggressive pricing because it's a commodity business to have somebody input that information. But in terms of why do people pay a few $100s a month to a CPA, or, in my case, a few $1,000s a month to a CPA firm, it's because of complexity and it's because of knowledge that you need. So if my main complexity in my life was my student loans, I would certainly look out for a firm that understands that. There's not very many out there that do have that knowledge, but that's what I would look for. If I was, a dentist with a practice, I would probably look for somebody that's really experienced in doing practice returns for my S Corp. And actually what some people are doing with what we're finding with our business is some people are hiring other firms to do the practice returns, and they're hiring us to do the personal returns. So, kind of an interesting approach, but I would say, pick somebody to do your taxes, ideally also ahead of time if you can, because you'll get a better deal and more attention when you're signing up. Another person asks, I've opened a business. Who should I go to for my taxes? Hopefully you don't have a ton of profit where you have to worry a whole lot about who does them in the first year, because those are due. If you have an S Corp return, it's due in mid-March, which is really coming up quick. Now, there's some great conversations that can happen with business owners throughout the year, and that's kind of, again, what we hope to do. Next question, tax advice for PhD students on a stipend. Oh boy. Someone also said, please expand also for residents and people in clerk years that are lawyers, etc., and students too. Well, so there's a lot of situations here. I mean, the main thing is if you have an income below 14 or 15,000, that's below the standard deduction, so you won't be paying much of anything in taxes. Your status, I think, depends on a lot of things in terms of like what will you be doing for healthcare. A huge part of tax planning for somebody that's a low income situation is ACA tax planning, keeping your taxable income above 100% of the poverty line. If you're in a state that didn't expand Medicaid or did expand Medicaid, that has implications in terms of how to get the best health insurance coverage, because that can, obviously really hurt you bad, right? If you show up to the doctor and you don't have great health insurance, the bills on that can be crazy. So I would say, if your main tax advice for somebody who's not making a whole lot of money is try to maximize your medical coverage and, maximize, if you have any extra money laying around, you can always do a Roth IRA because your tax rate is like basically zero if you're under the standard deduction or barely above it. Those are probably the main things that I'd say. Let's do another couple from Instagram, and then we'll switch over to our questions from our YouTube audience. So, person says, my spouse has no loans. I have 140K of a loan. Our income is 170 total with a couple kids. How do we file? Our current payment is a couple hundred a month, and I'm terrified it's going to go way up. All right, so a lot of it depends on what state they're in, and of that $170,000 of income, who earns what. So maybe it's 50-50 income. If that's the case, that's pretty great because you'd be talking about making like 80 something K, probably a very low tax hit from filing separate. And then for a family of four, you'd have the person that's the student loan borrower claim the two kids, and you get a deduction of probably about $55,000. So if the person's making 85 and their deduction's 55, 30K is the amount left over that the government gets 10% of on the SAVE plan. So you'd be paying $3,000 a year, divide that by 12, maybe about $250 a month or so. So you could keep that payment really low. So that would be an example of a situation where somebody should really look into that. Now, how can this get complicated in a hurry? Let's say this person had a spouse whose income doubled the next year. Filing separate might go from costing her nothing to costing them $5,000 or $7,000 or $10,000, depending on what tax brackets they're in. So this is how like the tax planning stuff really does matter. Final Instagram question, then we'll switch over to YouTube. Getting married soon. Will my husband's income affect my payments? Congratulations, first of all. Second of all, what we typically see is people will use their single tax returns until they have a married tax return to use together. And then you really don't have to worry about, your tax status until you're filing your taxes for the year after which you got married. So let's say you got married in 2024, tax season in 2025. This is the first time you'll file your tax return, married filing joint or separate. And then they won't probably find out about that return until sometime in 2025. So that's generally how the cycle goes for people that are getting married. We get that question more often than you think. All right, so now let's do a question on taxes from our YouTube channel. Resident Physicians wants to know, I'm on SAVE. I'm not sure about doing PSLF. Should I be doing pre or post-tax retirement if I don't get an employer match? Should I mix and match? Should I consider doing everything pre-tax, or should I do a backdoor conversion later before the Tax Cuts and Jobs Act ends and I earn a lot more as an attending? I'm just not sure what I should be doing. All right, so let's reframe this question and say, first of all, how great is it? How wonderful is it that you're even thinking about this, right? You're going to be fine. Like there's certain situations where somebody asks a question with a certain level of detail, and I instantly know the question or the reality for this person is their retirement portfolio. It's going to be a question of, is it going to be a $4 million portfolio or a $5 million portfolio? Right? That's what happens when you've got a resident physician who's already asking questions about backdoor Roth conversions. So I think that what people really want to do is they want to be a good steward of their resources, right? They want to not make a bad mistake because making bad mistakes makes people feel bad. And I would just say to this person, you can't make an awful decision no matter what you do, because either way, you're putting money away for your future. And if you do that pre-tax or post-tax, you're still in great shape. So that's the first thing, is let's tap the brakes and relax a little bit. So the response to the actual question is the sort of pre-tax benefits of retirement savings, even for fairly low-income people, are much better than you think because of student loans. So I'll just give you an example. Let's say you live in a state like, Illinois, 5 or 6% state income tax. If you're making above about 50, I think it's about 50,000 or so, maybe it's a little bit more, but if you're making above that level of income, you're in a 22% marginal tax bracket for federal. So if you're in 22 federal, 5 or 6 for state, you're pretty close to 30%. And then now added 10% for student loans, and you're at 40. Now with the same plan, if you're in residency, your payment's really low, $200-300 a month. So that means every amount of money you get your save plan lower by, you're getting an interest subsidy. It's a 1-for-1 match, right? If you get your save plan lower because you did let's say you did a $5,000 pre-tax contribution to your retirement, that saves you 10% of that number, which is $500, right? So that lowers your student loan payment by $500. That gets you $500 of interest subsidies. So it's a 1-for-1 match. So if this person does not do PSLF, they will get subsidies on their interest that will be literally money in their pocket, right? If they do go for PSLF, it's saving them, money on the payments that they will get more in the way of forgiveness. So that means that 22 plus 5 or 6 plus 10, you're talking about a 40% tax savings by doing the pre-tax instead of the post-tax. Will you save 40% in the future? Maybe that tax rate in total is maybe a little bit lower, but probably not that much lower. Let's say they revert back to 39.6% marginal top rate, and you have Illinois, it's still at 5 or 6. So your all-in rate, if you're making $600K a year, is about 45%. So, okay, yeah, sure, technically Roth, because your tax rate is lower now than in the future, but goodness sakes, if you're making 60, 70K a year and you're saving at a 40% pre-tax rate, go pre-tax all the way. The Roth is, it's a shiny object syndrome. It's fine. There's nothing wrong with it. If you'd done a Roth, it'd be fine. But look at that pre-tax savings that you're getting, and it's amazing. So that's what I would lean towards for anybody that's weighing pre-tax or Roth. I mean, I would do the Roth if you have the extra money lying around and you want to do your backdoor Roth IRA in addition to brokerage account contributions. But I would not lose any sleep over it. One more YouTube question we got was about the capital gains exclusion during home sales. So this is basically like if you live in the house the past 5 years, you can exclude, I think it's $250K as a single person or $500K as a married couple from capital gains. And this person has a very unique situation. This person bought their primary residence and lived in it for about 1.25 years. Then they began doing travel work, locums type work for 1 year, but maintained it as their primary residence. And this is what they said. They said they also abided by IRS itinerant work guidelines this 1 year. And then they rented out the 3 of the 4 bedrooms for several months, and then they sold the home. And the question is will they get that gain excluded? So I think that this is an example where I would pass this off to our tax team, and I'd say, let's do some research. And I don't want to give the wrong answer on this because it could be pretty significant, right? But I think that there's certainly different things to think about in this. Another question would sort of be like, what is the nature exactly when they were traveling for these IRS itinerant work guidelines? I mean, I just have to do more research on that, to be honest. So there's an example of your tax person, whoever it is. And by the way, I'm not a tax person. We have our tax team for that, but I just know enough to be dangerous, which is why I'm hanging out today with you guys. But in general, for those that don't know, if you have a house that you own for the past 5 years, you can sell it and in most cases really not pay any gains because most everybody's gain is below 250 or 500K as a married couple. One thing to keep in mind for this is if you did a lot of improvements to the house or investments in the house, that's part of your basis, which means that let's say you renovated your house. So I'll give you an example. So say we bought a house for 500K and we invested 500K in a renovation and we sell it for 1.2. The IRS is going to, if they don't know any better, going to say, oh, wow, they got 1.2, they bought it for 500, shouldn't they have to pay tax on 700K? Not so fast, IRS. We invested 500K in the house, fixing it up. So our basis in the home, which is what we paid for it, is now 1 million instead of $500,000. And then that means the gain would be on a $200,000 amount rather than, $700,000 amount. So those are just some thoughts about that home sale capital gains exclusion. Let's talk from Twitter now. We got a couple questions. Let's see. So somebody says, hey, I started a business. I had no revenue, but some expenses. Can I carry over those losses, or should I reimburse myself for those expenses? So yeah, you started a business, and yeah, it's pretty normal to have losses in the first year. The IRS knows that. So it's totally fine to carry forward losses that you have and offset future taxes. That's very normal to do that. Now, what the IRS does not want to see is you having a business that's losing money every single year for the long term, because then it starts to look like a tax dodge instead of something that's legitimate. So remember that, like, the IRS at the end of the day doesn't want to punch you down in the face and, I don't know, ruin your life. Like, the IRS just wants to follow the rules and, make sure people that are committing active fraud are taken care of. But, people that are trying to do their best, like you might try your best and still get hit with a penalty or interest or something. But in general, you're not going to go to jail unless you're just actively trying to hide things, right? So I think that this is a totally fine thing to do. Just carry forward your losses. Next question from Twitter. Pharmacist asked 4 years, asked about being 4 years into PSLF, and they've been filing separately from their spouse who has a really high income. And they want to know, when should we amend our taxes? When should we switch from separate back to joint to get some of this big hit to our taxes back? So this is a controversial strategy. I like to be cautious about things that are gray areas. That's just my nature, because I don't want anybody to ever get in trouble by any of the advice that we give to folks. And so what I kind of suggest on this is, okay, well, if you amend your tax return, first of all, you don't want to amend that tax return while the Department of Ed's using it. So if this person is, using a certain tax return to pay their loan payment and they recertify in November, we're going to wait until November. We're going to use that new tax return first. Once that new tax return is being used, now the one that was being used is no longer relevant, and you'd be free to go in and amend it and get the money back. Now, the way I would probably do this is in bulk. So you have up to 3 years in the past to recertify a separate return. You can't go the other way around. You can't go joint to separate. So you have 3 years into the past that you can amend a separate return. So in other words, 2020 tax returns could be amended all the way till April of 2024. And what I would probably do is wait until my new returns being used, and I'd probably amend maybe even 1 or 2 or 3 returns all at once, maybe 2 or 3 all at once if you can. And this way, this is an ideal situation for amending taxes, because I like the idea of amending tax returns for somebody that's doing PSLF, because it's a short period of time, right? You're doing it for a very limited window and you're done, you move on, life is good. But if you do this for 20 years, that's kind of a lot, right? Like, that's a little bit stressful, needlessly. It's just not, it's just not that helpful, right? So anyways, I think amending tax returns is something you file something called 1040X, and you amend from separate to joint, and you get money back. If you paid extra taxes, married filing separate, you can get that money back as a refund when you switch to joint. But you don't want to make it look super weird, which is why you wait until that tax return is no longer being used. And people might say, is this illegal? Well, there's no law against it. There's no rule against it. There's no regulatory guidance against it. It's a status you're allowed to file. 1040X is something that's very legal to do. People have to file it all the time because of various reasons. One time I had to file it because my CPA made a mistake and didn't include carry forward losses from my portfolio, and I wanted to make sure those were included for the future. So we had to file a 1040X and admit the mistake and amend it. All right, so last Twitter question, and then we'll have the special guest appear. If somebody is filing their taxes, married filing separately, are you encouraging them to link to the IRS or manually certify their income? It depends. So if you're filing separately for taxes, in general, yes, link to the IRS, because it's much easier just to use your tax return to get the payment that you want. Now, when would you not want to link to the IRS? Generally speaking, it's when you live in a community property state and you earn less money than your spouse. That's the best reason to say, no, I don't want to link to the IRS. Because why? Because in every other scenario, married filing separate income, the AGI is going to give you a number that's pretty solid. It's pretty good. If you live in a community property state, though, let's say you make 50, your spouse makes 100, you want that payment based on 50, not on 50% of the household income, which is 75 each. So in that case, you would not link to the IRS, you'd manually recertify your income. So hope that was helpful. Now it's time for our special guest, the head of our tax group, Rebecca Bauldauf. Welcome to the show, Becca.
Hey, Travis. Thanks for having me.
I just wanted to ask, how's it going?
Oh, it's going.
Tax season. Oh my gosh. So how is the first tax season with SLP Wealth going so far? Let's have the honest opinion.
There's definitely an interest. There's a need for sure. We have over 300 clients at this point. The list is still growing, but not for much longer. I think we're having a really good client experience as far as using our client portal and making it really easy for people to upload their documentation on their phone. So I think that's good.
Yeah, we're using all these like new tools, right? Like just things that didn't even exist a few years ago. Or they're just like kind of more walled off for people that have like higher cost CPAs. Like Canopy, right, is how we're using most of the stuff for getting documents from clients. Is that right? What has your experience been like using some of the different tax-specific tools this year?
Yeah, it's been really great because we've been able to kind of group together different priorities that we need to have as we're going through tax season. So if we need to expedite a married filing separate return for somebody that might have filed jointly for the 2022 tax year, but that married filing separate filing status is really important or critical to their student loan plan. So, that's been going well.
So we get that done quicker, in other words, to try to help that person get the right tax return to show when they have to certify. That's pretty cool. What are some of the other statuses, or if there are any, like that we are trying to watch out for people?
Yeah. So another one is if they have an income-driven repayment date between April and October, making sure that we file an extension for them, unless there's, other nuanced details contributing to a different strategy that may be employed, but that's one of the more generic ones.
How's the Avengers, the tax Avengers? What we call them? That's what does the team look like? Like who all is on the team these days?
Yeah, so we have a couple executive administrative support folks, and then we also have Lindsay, who's the expert for S Corps and business returns, and then Logan, who has joined us recently as well. And he's really looking forward to getting into the Schedule E, like the rental property stuff, as well as any Schedule C and multi-state returns as well.
And Logan used to be a psychiatrist, so that's kind of fun, right?
Yeah,
like
yeah.
He's a MD turned tax person, which is really an unusual. We find like some really unusual backgrounds for folks that reach out. Like we have like somebody on the SLP team who's like a podiatrist. We have somebody who's a former chiropractor, somebody who's a former veterinarian. So it's kind of cool that way. Like it's like, I feel like we have all this like free advice. Like, I'm just kidding. Send somebody a Slack message. Hey, my dog ate all this chocolate. What should I do? Just ask the SLP Slack. You don't even have to go to the vet. I'm just kidding. So we also have a couple other folks, right? So we've got George A. Am I missing anybody else on the tax side?
Kristen has been another huge support on the tax team as well, kind of helping out George A. Mm-hmm.
How exactly are we handling things when people have questions in terms of basically like the planners coordinating with you guys? Like that's a little bit of a different model compared to some places. Like, so how has that been going?
Everyone that is a tax client for SLP Wealth also has to be a financial planning client. And so in order to centralize who their contact is, we're having them primarily go through the planner, and the system that the planners use is called Nudge. And so, when people or tax clients have tax questions, there's a very specific nudge on that system that they can access and ask their questions, and someone from the tax team will respond to them. If they, a lot of times the planners can just answer the question as well. So if the planners can't answer the question, that's really when the tax team will get involved. And also if we're missing any documentation relative to preparing their return or anything, we'll also put it there, escalate there if we can't get it through Canopy.
One thing I think is really awesome is a lot of people don't obviously see what goes on behind the scenes, but you guys are constantly in the tax team meeting with the planners, are constantly having like office hours and working through client problems together. And it's just pretty cool to see. Like, I think you're doing a bang up job. So I'm proud of you. I know everybody's proud of you. What is something maybe we could do? Like, have you ever done like rosebud and thorn? Has that ever been like a thing that somebody has done for you? Like the thing you're really excited about that's going really well, thing that's like a pain in the butt is the thorn, thing that's going well is the rose, and then the bud is something you're excited about, love to see more of in the future. So I'm gonna go rosebud and thorn with SLP's first ever tax season. What would you say is something that, let's go with the rose first. What's something you're happy about how things are going?
I am so happy about the team that we have. We have some really excellent folks that are really dedicated to our client base, and they're just focused on service, and it makes it much easier to come to work every day knowing that I get to work with such great people.
I mean, that's really important. What about the thorn? Maybe it's software related, maybe it's tools, maybe it's the IRS. I don't know. What's your current thorn?
Yeah, the thorn right now I would say is tax prep software. Little known fact, but because of the privacy that is required and warranted for tax related information, it's important that that stuff stay secure. And so unfortunately, what that translates to is that our tax software doesn't really talk to anything else that we use. And so there's I don't want to say a lack of efficiency, but it's a pretty manual effort getting anything between the tax prep software and anything else.
I mean, that's just stinks, right? Like financial services, super regulated, super annoying. Like I think HIPAA is like a really great analogy, how awful things have to be in the healthcare world because HIPAA exists, which is very legitimate. People need to protect their health information, and I get it, right? But it's also kind of like, man, how baller would it be to go to the doctor and instead of some like awful form I fill out on paper, right?
Mm-hmm.
Like I could just get like a text to my phone and it's an app and AI can just look at my face and know like what my family history is or something. I don't know. I'm just joking around, but like you just have to do things a certain way when you're in a really regulated business,
Mm-hmm.
right? So that's a good thorn. What is something you're looking forward to, your bud, for the coming year in terms of taxes and the tax team?
I think the thing that I'm looking forward to most is the planning process, the tax planning and the strategy beyond just the student loan stuff, because it is so interconnected. And so I'm really looking forward to providing more value to our clients in that forum.
I think people don't really appreciate how special it is of what you're trying to do and what we're trying to do. This is going to sound like tooting our own horn, but like, I remember we sat through a bunch of tax software meetings, Becca, where basically the salespeople were just like, this is an amazing tool for you to charge like $40,000 and up to people that earn $50,000 and up in income. And, you can save them six figures in taxes. And, and the whole pitch was like, only work with wealthy people, ignore anybody that has less than 500K of income. They're not worth the time. Like that was literally what we got, multiple pitches like that,
Mm-hmm.
right? And it's like, well, you know what? We just want to help people. Like, yes, we want to make a profit and stay in business and be able to have a healthy work-life balance and meaning and earn fair compensation and all that. But I think it's just, again, so special what you're doing because we're literally trying to help student loan borrowers, people that make 5 figures and 6 figures, and not sort of multimillionaire tax clients, which is what the industry really targets, frankly.
Mm-hmm.
I mean, is that what you've seen?
Definitely. And what's sad to me is that the people with the 5 figures and the even low 6 figures, just barely 6 figures, the tax planning and the strategy with student loans and otherwise, that is the key to getting them beyond that point and building their lives and just opening up access to a ton of different things that they probably never thought that they were going to be able to have.
That's such a good point. That is such a good point. Like, because people use like the tax preparer at that income level, because that's what they can, that's what people pitch them. They can afford, right? Like the few $100 tax preparer that's not going to have any planning with them. That's not going to go into deep discussions. It holds them back because you're not getting feedback about doubling up on your charitable contributions or ways to use your retirement accounts better, or how to, maximize your FSA accounts better, or whatever it is. That's so exciting. So when did the tax planning meetings start?
Those will start in May of 2024. The only caveat to that for folks that are listening now, if they're not already signed up for tax through SLP Wealth, they will have to, we have to have at least one return that we've prepared on your behalf to really start providing that value.
Yeah. Basically, the gist of things for this tax season, which is like literally you're already deep in it, right?
Yeah.
Is maybe we have room for like about 50-ish people total. And then when we kind of hit capacity with the current tax team that we've hired for this tax season, we're done. So that would be people that have filed separately for taxes or need to file separate for taxes, community property people that want extensions. We're full already on S Corps. We can't take any more of those, correct? But if you just need any like personal return type of stuff, and there's the sign up fee, $1,000 plus $99 a month, because we have to do all this work to turn in your return in a rushed way.
Yep.
That's the idea behind that enrollment fee. The only catch is, like you said, you do have to be an SLP Wealth client for this. And for people that are student loan planner clients, or people that are already SLP Wealth clients that haven't added tax yet, or people that never have done a student loan consult for us, they can all go to slpwealth.com/tax. So if you go to slpwealth.com/tax, that link will take you with a questionnaire exactly through the right booking pattern of everything you need to book and sign up for if you want this service. And what would you say, Becca, to the person who really would want to consider this versus somebody that might just be able to DIY it? Like, what are you seeing in terms of the hundreds of clients that we currently have as to who's getting value out of this?
The people that are going to get the most and best value out of this are ones that are looking for a long-term partner relative to their financial life and getting that in order. And that's why we have, the stipulation of being a financial planning client in order to access the tax stuff, because it's not just a one size fits all, and we can't really like silo that. That's not how your life works in any regard.
And I mean, that's such a good point. That's why we want the financial planners talking to the tax people, because so often those things are disjointed, right? And your planner is like having this one-off meeting that they meet with your CPA once a year. And I guess in my experience, Becca, like, how much do you have to be paying your financial planner before they're willing to sit in with your CPA on a meeting? Mid 4 figures, high 4 figures, maybe?
Yeah. I mean, I don't even know. I've never had that luxury. So.
Like, I haven't seen, I mean, like, I've looked around like comparable pricing to price our product and stuff. Everything that I see is sort of like mid 4 figures a year for somebody that will coordinate with the CPA. Below that level, like, people just don't do that. And so the price all in with SLP Wealth for podcast listeners, if you do need us to do your 2023 return, there's that one-time $500 sign-up fee that jumps up a bunch February 15th. And then it's just $198 a month for all-encompassing financial planning, tax prep, all of it. So that's a great deal if somebody has all these student loan specific pain points and they just want and trust us to handle it for them. And if not, we love you to DIY it. Just to make sure you're careful with your married filing separate status or your tax returns or how you file an extension. Just be super aware of those things. And if you just decide at some point that you're just fed up, Becca, your current and growing tax team will, I think, be a great spot for a lot of the people listening to this to get some help. But I just thank you so much for how hard you work for clients and how much you've done to build the culture with our tax team being just a really positive group of people. So thank you so much, Becca.
Yeah, thanks. It's a blessing to work here, honestly.
Well, the person who's listening to this, you're a blessing too. So if you need us, slpwealth.com/tax. We'll have maybe 1 or 2 other tax-related episodes since we're in the thick things with tax season. And then we'll get back to just some usual Travis rants about student loan policy. So slpwealth.com/tax. Thank you so much, Becca. Y'all have a great rest of your week.